Hi class, for our final lecture video, or just video for chapter 2, I want to go over these transactions in the chapter 2 PowerPoint for this business called Overnight Auto. I want to use the accounting equation while we're working through these to help give you a better understanding of those assets, liabilities, and owner's equity, and really what a transaction looks like. So the business we're looking at, like I said, is Overnight Auto. So in this case, Michael McBrien opened up his own auto repair shop. So it looks like it's a sole proprietorship to begin with, where he's just opening up his own business. And he wants to keep good accounting records, although it's not a public business. He wants to set up financial statements and make sure those transactions are recorded properly. So we're going to start from the very first transaction, which will involve investment of capital, and work our way through. For each of these, I want to use the accounting equation. Remember, our accounting equation is as follows. It is assets equals liabilities plus owner's equity. So although this window isn't too large, I want us to be able to see both while we're working through these transactions. Okay, so the first transaction, it says on January 20th, Michael McBrien started Overnight Auto Service. He and his family invested $80,000 and received 8,000 shares of stock at $10 per share. So this is clearly a transaction because there was an exchange that took place, right? So he and his family invested $80,000 in exchange for shares of stock, or in exchange for ownership of this business. Okay, so in this case, this would be an example of a closely held corporation, one that's not on any kind of stock exchange. So these shares are only privately available, but that's besides the point. So we want to ask ourselves, what is going on here? Okay, so the business receives cash, right? And I'll have to erase as we go. The business, how much cash was put into the business? We just found $80,000, right? What is cash? Do you guys remember what cash is when it comes to these three categories? Cash is seen as an asset. So $80,000 of cash is being invested into this business. This business, its cash balance now has increased from nothing to $80,000. So we have an addition of $80,000 under assets. But the thing is, with a transaction and with the accounting equation, it always has to balance. You can't just have, oh, cash came in. Well, for what, right? What's the other half of that transaction? Where are the other portions of that transaction? $80,000 is not equal to nothing, right? We can't have $80,000 increase on the left with nothing else happening on the right. So we ask ourselves, what does that increase of $80,000 cash represent, right? Well, McBrien and his family, they received 8,000 shares of stock at $10 per share, right? These 8,000 shares, if they're valued at $10 per share, we get that same $80,000, right? So there's $80,000 of capital stock that was issued to his family in the form of 8,000 shares. So is capital stock, from our last discussion, is capital stock considered a liability, or is it considered part of owner's equity? It's considered part of owner's equity, because owner's equity is made up of capital stock and retained earnings when it comes to a public business. Okay, so here we balance now. There doesn't have to be any liabilities involved in this transaction, because guess what? $80,000 on the left is equal to $80,000 on the right, and we are good to go. We aren't yet learning how to journalize this. We will get to that in chapter 3. But what we want to figure out now and really get a good handle on is, okay, here's a transaction. How does it affect the accounting equation? And we want to be able to illustrate that as follows. So now here you can see under assets we have cash now. All of a sudden the cash account has a balance of $80,000. Now all of a sudden the capital stock account has a balance of $80,000. So we're starting to build that balance sheet. Okay. Next transaction, transaction number 2. And I'm going to, I want to keep part of this as much as I can. I'll erase basically the work for the prior transaction as we move on to the new one, since I only have so much room here. Okay, so that was transaction number 1. This will be transaction number 2. So on January 21st, Overnight purchased the land from the city for $52,000 cash. So you ask yourself, what exactly is happening here? So Overnight, the business, they bought land, right? So the business is now an owner of this land. And how did they pay for that land? Is there a mortgage? It says they paid for the land in cash. So what happened to Overnight Auto's cash balance? Remember, previously, prior to this transaction, we know that there's now $80,000 in that cash account. But now when they're buying land for $52,000, what do you think is happening to this cash account? It is dropping. And exactly how much is it dropping? $52,000. So we need to show that our cash, which is an asset, is decreasing by $52,000. And in accounting, I'll mention that now, instead of us putting minus 52,000, a shortcut and really what's common practice and best practice is to show a minus or a negative with parentheses. Okay, so we say, okay, our cash balance fell by $52,000. Well, what's the other half of that? $52,000, a decrease on the left needs to be balanced with some activity on the right here. Is there any liabilities involved? No, we don't see anything, right? Is there any owner's equity involved? I don't see any of that either. Well, then, what now? That doesn't seem like we're balancing. Well, cash is an asset, right? But what did you spend cash on? You spent cash on land. And what would land be considered as? An asset, liability, or owner's equity? Since Overnight is the owner of this land now, this land is also considered an asset, because remember, an asset is anything that a business owns, right? So this land, all of a sudden there's a land account now. This land account has increased by $52,000. So at the same time that my assets are decreasing by $52,000 because my cash balance fell, my assets increased by the same amount because I just purchased land. I purchased a new asset of $52,000. So are we in balance now? A negative or a decrease of $52,000 plus an increase of $52,000, that just cancels itself out, doesn't it? So are we in balance now once again? Yes, we are. So on the balance sheet, all of a sudden now you have land, right, listed at $52,000. Remember our historical cost principle. Land is one of those assets that you're always going to record it at whatever you paid for it. As long as you still own the land, it's on the balance sheet at what you paid for it. So 10 years from now, when you look at that balance sheet, if you still own the land, what should we see when we look at the land account? We should see $52,000. Okay? But when I look at the balance sheet now, after this transaction, should cash still show a balance of $80,000? No, it should not, right? Because we don't have $80,000 anymore. You spent some of that $80,000 on this land. So the $80,000 that you had minus the $52,000 that you just spent leaves you with a cash balance of $28,000. So that's why now here you see that cash shows $28,000 and land shows $52,000. But the balance sheet is still in balance because we've made sure with these two transactions, anything I do on the left is balanced out by anything I do on the right, right? And with the second transaction, nothing happened on the right, but a couple things happened on the left, but it balances because the two things that happened on the left cancel each other out. Okay, so that is transaction number 2. So I'm going to go ahead and get rid of this work here so we can move on to the next transaction. On January 22nd, Overnight purchased an old garage for $36,000. And we'll refer to this garage. Why not? Well, because we see here they refer to it as building, so they bought a garage building. for $36,000. Now we ask ourselves, okay, awesome. Let's start there. They purchased an old garage. Purchased meaning they own it. They're not renting it. Okay. So what is a building? Is it an asset, liability, or owner's equity? It's an asset, right? So with this third transaction, this building is an asset. So if I just bought a new building, doesn't that mean my assets have gone up? And how much have my assets gone up? They've gone up in the amount that I've just paid for that building. So my assets should be going up by $36,000 here. But we're not in balance yet, right? We have to figure out, okay, what else happened within this transaction. So it says overnight paid $6,000 down in cash and issued a 90-day note payable for the remaining $30,000 owed. So there's a couple things happening here. What does it mean when you put cash down? It means that you are paying for this purchase partially in cash, and the rest you will pay off over time through a loan. But they paid $6,000 down in cash. So what's happening to your cash account? If you're paying $6,000 in cash for this building, what's happening to cash? Is it going up or down? Cash should be going down, shouldn't it? Right? And cash is what kind of account? Is it an asset account, liability account, or owner's equity account? We know that cash is an asset, right? So if cash is going down by $6,000, so should my assets go down by $6,000. So at the same time that assets are going up by 36 because I bought a new building, my assets are also falling by 6,000 because I just spent some of that cash to buy that building. So what's the net effect here on the left? If assets went up by 36 but down by 6, overall the increase to assets is simply 30,000, isn't it? But an increase of 30,000 on the left needs to be balanced out by something on the right. If they only paid $6,000 cash, doesn't that mean they still owe? They're still going to have to pay off the loan, right, that they secured to buy that building. That loan is what we call a note payable. They have 90 days in this case to pay off this note payable. So if they paid $6,000 down on this $36,000 building, how much do they still owe on the building? $30,000. Okay? And a note payable, if you recall from our Chapter 1 discussion, a note payable is what kind of account? It's a liability, something that needs to be paid off, something that the business owes, right? A debt or a financial obligation. That's what a liability is. So have my liabilities gone up or gone down because I now owe money to someone else? If you owe $30,000 all of a sudden now to the bank or whoever it is, your liabilities are going up, right? The more debt you have, the more liabilities you have. And as debt goes up, liabilities go up. So your liabilities are going up by $30,000 because of this note payable. There's no owner's equity. There's nothing else mentioned here. Okay? So now on the balance sheet here, we now see a cash balance of $22,000 because remember, prior to this transaction, we had cash of $28,000 left, right? And now spending another $6,000 of that only leaves us with $22,000 left. So that's why cash now shows $22,000. That building's still there at 36, and that land is there at 52. So as soon as we bought this building and our assets increased, we now have to include that building as a separate account on the balance sheet at $36,000. So as long as I own that building, whether it's 1 year from now, 10 years from now, 20 years from now, it's still going to be showing up on this balance sheet as $36,000 account balance due to the historical cost principle. Okay, but now all of a sudden we have something under liabilities, right? We have that note payable account that's now been created and has a balance of $30,000. And if we add all these asset balances together and add all the liabilities and owner's equity balances together, we see that they're equal to one another, which it should be, right? This accounting equation you see up here is basically the balance sheet. Everything on the left needs to equal everything on the right. And how in the world does this 110 equal the other 110? Because with each of these transactions so far, we've made sure that anything on the left is counterbalanced by anything on the right. Okay. I'm going to try and scroll just a slightly up. We don't need the overnight auto name there. This arrow is unfortunately in the way, but that's okay. Okay, I'm going to get rid of this work here. Okay, on to transaction number 4. I believe, yeah, I'm not missing anything. Okay, transaction number 4. So on January 23rd, Overnight purchased tools and automotive repair equipment for $13,800 on account, due within 60 days. Okay, so what's happening here? It says they bought tools and equipment. And if they bought it, they're not renting it, it's considered an asset, right? It's ours, or the company's. They bought the tools and equipment for $13,800. And tools and equipment, what kind of account is that? It's an asset account, right? So if I bought more assets, what's happening to your asset balance overall? It's going up because you bought tools and equipment, which increases your assets. So your tools and equipment account, which is an asset, is going to cause overall assets to go up by $13,800 here. But we have to balance here on the right-hand side. Okay, I'm going to bring that down back again because you can't really see the owner's equity. Okay. So the tools and equipment asset goes up by $13,800, but then what's the other half of that? So it says here they bought this tools and equipment for $13,800 on account. So what does it mean if you buy something on account? That simply means I'm not paying for it in cash at all. I'm not even putting part of it down in cash, right? If you buy something on account, you're basically taking out a loan. You're getting to pay for it later. And when is this $13,800 due? It's due within 60 days. So anytime that you owe money that needs to be paid back, is it an asset, a liability, or owner's equity? It's considered a liability. So we have our liabilities also going up by $13,800. And why is it going up? Because now all of a sudden I owe more money to someone else. And as soon as you owe more money, your liabilities go up. So in this case, we also have an increase of $13,800 to our liability category. But what kind of liability? Okay, so it says it's due within 60 days. And they added this $13,800 loan into and called it an accounts payable. Both notes payable and accounts payable, they're both liability accounts that represent loans of some sort. The only difference is an accounts payable tends to be shorter term. It says this loan is due within 60 days, so that's why it's we added it to an accounts payable account. Notes payable, it can be short term, but usually notes payable involves the payment of interest, and there's an official note or a loan agreement that is signed. So those are some of the main differences between these two. Okay, but usually it'll be pretty clear which one of these a liability would need to be added to. Okay, so we bought an asset for $13,800, so the assets go up by that amount, but we financed it through debt. So we took out an accounts payable loan, and we're increasing that account by $13,800. Our liabilities are also going up by that same amount. There's no owner's equity involved here, so we are in balance. So you can see here there's no change to cash, no change to buildings or land, but all of a sudden we have this new asset account added in under assets, tools, and equipment, in the amount of $13,800. But where's the balancing of that? It's balanced by this accounts payable account that was added in. So this accounts payable now has a balance of $13,800. And we're in balance. Our assets in total equal our total of liabilities taken together with owner's equity. And again, why is that? Because we've been careful with each single transaction to make sure our accounting equation is in balance. Okay, we'll move on to the next one. And also, I encourage you, as you work through this, I want you to be working this with me. Have a piece of paper out and pause and rewind as necessary to make sure you really understand these transactions. Okay, transaction number 5. Overnight realized that the company had purchased more tools and equipment than it needed. On January 24th, Overnight sold some of these new tools to Ace Towing, someone else, another business, for $1,800, a price equal to Overnight's cost. Ace agreed to pay the amount within 45 days. Okay, so here there's more than one element involved. Okay, so that tools and equipment, the $13,800, we decided to sell some of those tools and equipment to another business. But did we make any profit off of this? Because that's a little bit more advanced than for our purposes for this chapter. There's a reason they say that they sold part of those tools at a price equal to cost. They did not make any money off of this transaction. They sold some of their tools to Ace Towing for exactly what they paid for those tools. So there's no profit or anything here. So after they sell some of those tools, should there still show $13,800 of tools and equipment on the balance sheet? There should not, right? How much did they get rid of? They sold $1,800 worth of those tools to someone else, right, at cost. So the tools and equipment account has decreased by $1,800. Okay, I no longer have some of those tools and equipment, so I have to make sure I reflect that in my tools and equipment asset balance. So that means I'm left with $12,000 of tools and equipment. They made a little typo error here. The tools and equipment should be shown here at $12,000 now after this transaction, but they accidentally showed it as $12,800. So just keep that in mind. So now I have $12,000 of tools and equipment left over. So what happened so far on this asset side? My assets fell by $1,800. Okay, but what else is happening here? It says they sold those new tools to Ace Towing for $1,800. Ace agreed to pay the amount within 45 days, so relatively short term. So are we receiving cash right away from Ace Towing for the $1,800 worth of tools and equipment? Are we getting cash right away from that other business? No, right? Because it says Ace agreed to pay the amount within 45 days. They get to pay later. So is there any cash involved in this transaction? There is not. But there is this one asset account that's the next best thing to cash. And that next best thing to cash is what we call an accounts receivable account. An accounts receivable account is basically, when you look at the balance of such an account, it's basically a total of what other people owe me or owe the business, right? So if we didn't receive the cash right away, we're going to receive cash later. That's where an accounts receivable account is required. How much cash are we going to receive later? How much cash do we expect to receive within 45 days? $1,800. Okay? And if accounts receivable is the next best thing to cash, it's just cash later, right? What kind of account is it? Is it an asset, a liability, or an owner's equity account? This is still an asset, okay? It's the next best thing to cash. It's almost always listed right below cash on the balance sheet. So at the same time that our tools and equipment account, which is an asset, decreased by $1,800, we have this accounts receivable account that increased. Oh, I don't want to parentheses there. That increased by $1,800 as well, while the tools and equipment decreased by $1,800. There's no liability account involved here, and there's no owner's equity account involved here. We're balanced strictly on the left, only by those two asset accounts. So at the same time that our tools and equipment account balance fell by $1,800 because we sold some of it at cost, our accounts receivable account increased by $1,800, which is also an asset because Ace Towing has agreed now to pay us this $1,800 later in exchange for these tools, these $1,800 worth of tools. Okay, and again, aside from that typo, we are in balance here. Once again, Our cash account was untouched. The only thing that changed here on the left is all of a sudden we have now a accounts receivable account with a balance of $1,800. And we have a tools and equipment account that fell from $13,800 down to $12,000. And nothing changed on the right. Okay? I'm going to get rid of this work once again. Bear with me. Okay, on to transaction number 6. On January 26th, Ace Towing pays overnight $600 as partial settlement of its accounts receivable. So remember, we have that accounts receivable that had a balance of $1,800, right? The amount that Ace Towing owed or owes overnight auto. Okay, but now it says by the time January 26th rolls around, they decided to pay off a portion of that $1,800 that they owe us, right? Because they said they'd pay it all within 45 days. So now they're deciding to at least pay a part of that before those 45 days are up. So what's happening if you're getting, if the business is getting paid $600? We're owed the $600, right? And over Ace Towing is giving us $600. If someone's giving you $600, you are receiving cash, right? Whether that's actual cash or a check or electronic funds transfer, whatever it may be, right? They're paying part of the amount off that they owe us. So cash is going up, isn't it? We're receiving $600 cash. So cash, the cash balance should be going up by $600, which means my total assets are going up by $600. But now the question is, if they're paying me $600 now, do they still owe me $1,800 now? No, they don't, right? If they owed me $1,800, but now they've paid me $600 of what they owe me, how much do they still owe me? They still owe $1,200. So when I look at the accounts receivable account balance, should it still be listed at $1,800? Because remember, accounts receivable says what other people owe me. Do other people owe me $1,800 still? No. What's the new balance in accounts receivable? It should now only be $1,200. Okay, so what happened to accounts receivable? Did it go up or did it go down? At the same time that cash went up, right, because I received cash, they owe me less now. So the balance in accounts receivable went from $1,800 to $1,200, right? So my accounts receivable account decreased by $600 at the same time. Okay, and again, I don't want to come in the habit of doing the minuses. We want to do it in parentheses. So our cash went up by $600, while at the same time accounts receivable went down by $600 as well. And there's nothing else happening here on the liability side or the owner's equity side. Okay. Go ahead and get rid of that work. All right. Transaction number 7. On January 27th, Overnight made a partial payment of $6,800 on its account payable to Snappy Tools. So remember, they had purchased those tools and equipment on account from someone else, right? So all they're telling us now is we're paying a part of that accounts payable that we had originally owed. Because remember, the accounts payable was sitting at $13,800 of what this business owed to that Snappy Tools business where they bought the tools and equipment from initially. But now what's happening is they're paying off a portion of this accounts payable. Overnight Auto is. Okay, so how do you pay off debts? You pay off debts with cash, right? So how much cash are they saying they're using to pay off part of that debt? $6,800. So if you were using cash to pay off a debt, what's happening to this cash? Cash is going down, and cash is an asset, so assets should be going down by $6,800. Okay? But what about the accounts payable as well? What's happening to accounts payable? Accounts payable shows what I owe someone else, right? Or one kind of account that shows what I owe someone else. Do I still owe $13,800 if I just paid off $6,800 of that? No. How much did your account payable balance fall then? It also was decreased by $6,800. Because if I owe less now, my liabilities are going down. If accounts payable decreases, so does the overall liabilities balance. So that's why now we show a cash balance of $15,800, right? Because previously we had $22,600 in cash, but then we spent $6,800 of that to pay off a loan. So we have $15,800 left in cash, and then our accounts payable went from $13,800 to only having a $7,000 balance left over. Because 13,800 minus 6,800 is that 7,000. And in this case, there's nothing happening with owner's equity in this transaction. So we are in balance. And we are still in balance in the balance sheet. So keep in mind, everything I'm doing here is basically what's happening here. This is just in neat balance sheet form. So your assets equals your liabilities plus owner's equity, both in balance sheet form and in the equation form. But they are one and the same. Okay. Okay. And transaction 8. January 31st, overnight recorded auto repair services provided for the last week of January of $2,200 received in cash. So I'm going to have to scroll up a little bit for this one, as long as we know where everything is. So the auto repair shop, they provided services in exchange for cash. So first of all, what's happening to cash? We received cash, $2,200 cash. So cash is going up in the amount of $2,200. Okay, but something else is happening as well. What did you receive that cash for? You provided a service. And in exchange for providing that service, you got cash. So you earned that money, right? Whether you got that cash today or they promised to pay you later, you still earned that money. So whenever you provide a service, that means you've earned money or earned the promise of money later. And that's what we call revenue. We've just generated revenue. And specifically service revenue in this case, right? We've generated revenue. And revenue is an account, but it's not a balance sheet account, it's an income statement account. But remember that idea of financial statement articulation, everything's connected, right? Although this is an income statement account, right? Because the income statement shows revenues minus expenses, revenue impacts the balance sheet. And we briefly touched on how it impacts the balance sheet. Okay, revenue went up in this case. How much did revenue go up by? Revenue went up by $2,200. That will show up on the income statement, of course, but now we're looking at the balance sheet. Revenue, when revenue goes up, retained earnings goes up. Okay, so we'll learn how that happens in later chapters. Okay, but we don't have to worry about those details at this moment in time, but just know when revenue goes up, retained earnings will also go up due to an eventual journal entry that we'll learn how to do. Okay, so if we know cash went up by 22 and then also retained earnings goes up by 22, is retained earnings considered a liability? Is that money that I owe someone else? No. It's part of owner's equity. Remember, for a corporation, owner's equity is made up of both capital stock, the capital stock account, and the retained earnings account. So our owner's equity went up by $2,200 as well. So the increase on the left of cash on the asset side is equal to the increase on the right under owner's equity due to retained earnings. And also there should have been pluses throughout this whole thing, but that's okay. That is it for transaction number 8. And if there's any of these transactions where you're left feeling confused, just make note of them in detail. And we can make sure to touch on that during our Zoom class. And last but not least, transaction number 9. It says on January 31st, overnight paid operating expenses of $1,400 cash. In $1,400 cash. Okay, so it says they paid operating expenses. So let's just assume that the $1,400 in operating expenses refers to fuel expense. Okay, so what happened here if you paid for that fuel in cash? Is cash going up or down? Cash is going down, and cash is an asset. So that means assets are going down by $1,400 because I just spent $1,400 on operating expenses, and we're using an example of saying it's fuel. Okay. Now, operating expenses, so we're assuming it's fuel expense. Is fuel expense a balance sheet account? It is not. This is an income statement account because remember, revenues minus expenses is what we see on the income statement. So this will show up on the income statement, but doesn't mean it doesn't affect the balance sheet. No, remember, everything's articulated with one another. So fuel expense is actually a kind of account that you will see, that will show up. But fuel expense, although an income statement account, will affect the balance sheet. When fuel expense goes up, or when any expense goes up for that matter, it has the opposite effect on retained earnings that revenue does. So increases in revenue make retained earnings go up. But increase in expenses make retained earnings go down. It has an opposite effect. Okay? So because we have more of an expense, that means retained earnings goes down. And remember, what kind of account is retained earnings? Retained earnings is an owner's equity account. So owner's equity is decreasing by $1,400 as well because retained earnings is going down by that amount. And there's no liabilities involved here. So why? And again, each of these, as cash goes up and down, the change should be reflected by the ending balance here as we go through all these transactions. I wasn't looking at that in each of these necessarily. But now when you look at retained earnings on the balance sheet, why does it say $800? Well, first of all, when you start a new business, you start with no retained earnings. It has zero balance. But when we recorded this revenue, remember, retained earnings went up by $2,200. But then as soon as we incurred and paid for this expense, retained earnings went down by $1,400. So a beginning balance of $2,200 minus a decrease of $1,400 leaves me with a retained earnings balance of $800 on the balance sheet here. So this change in retained earnings is balanced by this decrease in cash on the left-hand side. Okay, so that is it for going through those transactions. In Chapter 3, we're not only going to be looking at how these transactions affect the accounting equation, but we're actually going to learn how to journalize them using those debits and credits and those T accounts, which many of you might be very unfamiliar with. So we'll be dealing with that in Chapter 3. So hopefully that was helpful. I really want to urge you to make sure that you go through these enough that these transactions make sense and that you practice with them. And make sure you relay any questions that you have either to me. You can also ask Ginny, but remember to please make good use of that question forum. But your starting point really should be that discussion forum for Chapter 1, the Let's Talk About It. That's actually graded. So that would also be a good place to start with regards to discussion of Chapter 2. I don't know if I accidentally said Chapter 1, but I was referring to Chapter 2. Okay, so good luck with the rest of Chapter 2, and I'll see you guys in class.